Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 9, the exercises for Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. You still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, and as we move forward, we're going to be getting into more of the difficult concepts. I mean, if you watch that first exercise was, to me, just simple. Okay, it's something you should have down. But now we're going to be getting into things like estimating your warranties and then bonds. So the subject matter is going to get more and more difficult here. And if you don't understand those underlying concepts, you need to go back and revisit them before you can apply them to the situations at hand. Okay, so for this video 9-30, it says here, the accounting records of Tim's Auto Repair showed a balance of $1,600 in warranty payable at December 31st, 2013. So I have warranty payable, and it has a balance of $1,600 in it on December 31st. In the past, Tim's warranty expense has been 3% of sales. Okay, so during 2014, Tim made sales of $386,000 on account and paid $94.20 to satisfy the warranty claims. Right. So as I was reading that, you saw me draw the T account here. Then Tim's warranty expense has been 3% of sales. So I know that I'm going to have to find my sales and take 3% of it to get my estimated, right? My estimated warranty payable, right? And those sales are on account. So I might have to record those sales as an accounts receivable. And then of course I'm paying $94.20 to satisfy the warranty claim. So this $94.20 is going to go against whatever it is that I calculated for that 3% as my estimated sales. That's what was running through my head, okay, as I was reading that. And you should be thinking the same thing, not just blindly reading, like reading the information as a romance novel. All right, so journalize Tim's sales, warranty expense, and cash payments made to satisfy the warranty claims during 2014. As I was reading that and I was working through all that, that's, it's like telling the future there, okay? Explanations aren't required, ignore cost of goods sold, right? So record the sale, right? So if 386,000 on account. So am I affecting cash? No. Am I affecting accounts receivable, accounts payable? Yes. So I debit accounts receivable for the 386,000 and I credit my sales revenue for the 386,000. Okay, now my warranty expense, right? So if my estimate is 3% of the 386,000. So 386,000 times 3% is going to be $11,580. Okay. So I'm going to debit my warranty expense for the $11,580. Now, remember, the reason why we're making this calculation here, because remember, we're paying $94.20 to satisfy the warranty claims, but we're making the estimation of 11,580 in order to match, using the matching principle, in order to match our revenues with our expenses. Okay, we're booking revenue here of $386,000, but we can't, we have no idea what claims are actually going to come in. All right, we don't know about this $9,420. Okay, we know that we have sales of 386, and we have to match the revenues with our expenses. So we make the estimation of the 11,580 in order to match up the revenues with expenses. So I end up crediting estimated warranty payable for the $11,580. That's the reason why we make that entry. Now, this is a journal entry, this is a journal entry, all right? We need to, when I post it to the ledger account, remember this is my estimated warranty payable account. When I post it to this account, okay, I am going to credit $11,580. Okay, so that's going to be my new, whatever amount that adds up to is my new balance in the account. This here $1,600 was the beginning balance, and realize that that $1,600 beginning balance was just the remaining balance of this process. I had estimated a warranty, my warranty payable, just like I did here for the $11,580, and then that gets offset by whatever is actually claimed against that account. Okay, so we make this estimation thinking, oh, this is how much we're going to have in warranty payable, but then we actually only pay out $94.20. So my entry to, for the cash payments to satisfy the warranty will be a credit to my cash, right, for the $94.20, and a debit. We're not putting that debit against the warranty expense, right? This here entry is what we made in order to book our expense originally. So the expense has already been incurred. It's already hit our books when we make this journal entry. But when we pay out the payable, this here's that is a liability. So I will debit my estimated warranty payable for the $94.20. Okay. And in doing that, when I post this entry to my estimated warranty payable account, I'm going to, that's going to be a debit, which now gives us a new balance in the account of $37.60. Add up my credits, add up my debits, subtract one from the other, and my new balance in the account, the estimated warranty payable account, is $37.60. Okay? And you're going to do this for that's sort of like a cyclical recurring process, in that I have this balance. Okay, actually I should do this in blue. I have this balance. Okay, at the end of the period, which generally is at the end of the year. Okay, I'm going to estimate my, make an estimation based upon my sales of how much how much I expect to have in warranty expense, and that gets the expense on my books to match my revenue. Okay, but I haven't paid it out yet, so that's a liability, and so that's why we put we put it to the warranty payable account, because it's something that we're going to owe as the claims come in over the course of time. Okay, and that's what's happening with the $94.20. People are coming back and saying, oh, this is broke, it was under warranty, and you're going to give them their cash back. And so during that period of time, and it doesn't happen on one day. So as those claims come in, you are going to be offsetting this warranty payable account as the liability. All right, and then at the end of the accounting period, you have a new balance, and you do the same exact thing again. All right. So that's generally it for warranties. The only other thing that I can mention about warranties, I mean, they work the same exact way all the time. The only thing that I'll mention is that, for these examples, if you had done the short exercise problems, or the example in the textbook is that, generally they're just on the simple side. They're taking 3% of sales. Okay. And over the course of the year, using a percentage method like this is fine. Just realize that you need to regularly, and when I say regularly, I don't mean every week or every month, but like every year, you need to take a look at that percentage, okay, in order to make sure that it's accurate. Because let's say your quality control, the quality of your product goes down, right? That means you're going to have more in claims. So that percentage might not be 3%, it might go up to 4%, okay? And it might go up to 5%, right? And if your quality control is good, it might go down to 2%, okay? You need to keep looking at that percentage in order to make sure that you have an accurate accounting for your expenses, okay? So, and that's just using that percentage method. I mean, there are some other methods that you can use, but they're all, specialized. If you're an accountant, which most of you aren't, but if you're an accountant, you'll look at this again in like intermediate accounting, and there are other methods that you can use, and you can even actually make up your own method as long as you can just justify it, okay? But that's something for, down the road. Right, so that's it for this exercise, and if you didn't understand it, watch it again. Go back and watch the theory videos for the warranties, and if you still don't understand something, feel free to contact an instructor.